Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial. I'm your host, Mark Bunting, the host of RCTV. This is the fourth of these live core conversations that we've done, and they're proving to be very popular. We talk to thought leaders in the mining and commodity sector. We get their insights and we learn a lot. Next week, by the way, our featured guest will be Mark Selby, the CEO of Canada Nickel. So you're going to want to tune in for that. Today, we are delighted to tell you that we have Jim Anthony as our guest. He is a founder and the former chair of Seabridge Gold. Let's not waste any time. Let's bring him in here. Jim Anthony, thanks for joining us today. How are you, sir?
Very good, thanks. Good to see you, Mark.
You as well. Now, as you know, as we sit here, gold is near an all-time high, $2,500 an ounce or so, a little below that. And you wrote a report a while ago that was part of the annual general meeting report from Seabridge. And in that, one of the things you said was that 5 things have happened with gold that shouldn't have happened. They are atypical from what we've seen in the past, such as real interest rates and gold going up at the same time, such as the US dollar and gold going up at the same time. So could you briefly run us through those 5 things and whether anything has materially changed since you wrote that report?
Sure thing. Yeah, this is a very unusual gold market. And in fact, we're breaking all the rules, as I think I indicated at the annual meeting, and it's still true, although we are seeing some changes. So first, yes, gold is up and so are real interest rates. That's really unusual. Positive real rates currently about 2.5%. More typical of a $1,300 gold price than a $2,500 one, which is pretty close to where we are today. That's going to change as the Fed cuts rates, but currently that's still the case, and it's unusual to have gold going up while real rates are this high in positive territory. Secondly, yes, the dollar has been pretty strong. Its DXY has been 103 to 107 area during most of this run in the gold price. That didn't happen in the last gold bull market when, the dollar after the global financial crisis basically fell out of bed and gold went up correspondingly, and that's typically what you would expect. Then we had a yen carry trade unwind, which was part of what was driving the DXY. And we have another even larger yen carry trade right now that looks like it's starting to unwind. So this factor may reverse, and we may have a weaker dollar going forward, and we probably should have if the Fed cuts rates as expected. But currently, nonetheless, gold has gone up while the dollar has been strong. You look at COMEX. COMEX open interest currently is about 500,000 contracts. It just poked its head above 500,000 just in the last couple of days. But you go back to 2011 in the last gold bull market, open interest hit 800,000 contracts. So there really hasn't been the kind of speculative interest in Western investing that you would typically see in a gold bull market. Now, ETFs have probably been the big story, and a lot of people have been commenting on this, the ETFs, the global ETFs, have been divesting gold at a furious rate. Over the 2 years ending roughly mid-May, they sold net 989,000 tons of gold, and that's an awful lot of gold. But the reason being that 90, 980 tons, sorry, no thousands there, but the reason being, again, that interest rates were positive, real rates were positive. So the Western investor was a seller, and that kind of volume was more than 30% of global ETF holdings. So again, you wouldn't expect to see that. Asian investors were buyers on price increases, which again is very unusual. Usually they are sellers as the price rise. They're very price sensitive. Now, the ETF situation is starting to turn, probably. As of mid-May, we've had a net increase of about 52 tons of gold in the ETFs globally. So that may again indicate that there's a turn as Western investors start to look forward to Fed rate cuts and a decline in real interest rates. So all of those factors are still operative, but showing signs of shifts that could bring the Western investor back into the gold market in a big way. And if we get that on top of the Eastern demand that has been continuing, then that's going to bring us the next leg up in the gold price. Now, I should mention that while we've had all this ETF selling, what's been on the other side is a large amount of central bank buying. 2022, central banks bought over 1,000 tons of physical gold. 2023, the same. 2024, it's continuing, which is very good to see for those who want a higher gold price. It slowed down a bit in the second quarter, but nonetheless, in the first half this year is 5% over the first half of last year. So, the central bank demand is still there. Now, it looks like China may have stopped buying. They did not report any sales in May and June. So again, is this a change? And you've asked, okay, are these factors under revision that have been driving the gold price? And we think not. If you look at total gold holdings by the People's Bank of China, it's about 4.9% of their total reserve, which is up from 1.8% since 2015, but it's way short of where they want to be. The average central bank has about 16% of reserves in gold. They're at 4.9%. And we've had several central bank officials say they wouldn't mind being at 20%, which would put them roughly where the United States is, if you believe their official stated reserve of 262 million ounces. The People's Bank of China is only at 74 million ounces, so they've got a long way to go. They need to keep acquiring gold, and perhaps they still are. Some people think they still are through other channels than the officially reported one. So all considered, it's been a very different gold market, but maybe the factors that have made it almost entirely an Eastern and Asian driven market are going to change here with the West starting to add its demand as well.
Well, let's pick up on that theme, Jim. The fact that we have seen this shift from west to east with Shanghai and Singapore exchanges dominating. Can you elaborate on that a bit more, flesh it out, and again, maybe give some more evidence that perhaps that's changing back the other way to a degree?
Yeah, it's interesting. I mean, London is still the number one gold trading hub and probably will be for a long time. But at the margin, it hasn't been the price setter. That's been done in Shanghai, Singapore, Dubai. You look at simple things like the export data from Switzerland. Why is that important? Well, the four biggest gold refiners are Swiss. Where are they sending their gold? Well, 3 years ago, they were sending it to London. The last couple of years, they've been sending it to Shanghai and Singapore and Dubai. The reason is that those markets are generally trading at a premium. They're bidding up the price of gold because they want it. So that's where we're seeing most of the gold action in terms of price setting. You look at why is that? Why are they interested in a premium? Why are they not so price sensitive? The primary reason, I think, is that you're seeing demand among BRICS nations about the need for gold to satisfy some of their objectives, which are to act as a final settlement in trade negotiations, particularly for energy. But also, if you look at comments by people like Jeff Curry, who is current, former head of commodity trading at Goldman Sachs, and currently at the Carlyle Group. He's one of the kingpins, really, of commodity trading worldwide for the last couple of decades. He's talking about the fact that gold is now circulating just the way only the dollar did even a couple of years ago, and that as a circulating asset, it has more value and more interest, particularly to the BRICS nations, to Asian nations, than as a passive reserve asset, which has been primarily its function in the West.
Well, that's really interesting, and let's keep that going because you've also said, and you hinted at this in your comments there, that increasingly we're seeing in various parts of the world oil contracts being settled not in U.S. dollars or yuan, for example, but in gold. So how significant is that? What's the importance of it? And do you think the market largely is underappreciating that fact?
Probably not fully appreciating it yet. There's an interesting story here. First of all, just to look at the facts, in 2021, the gold trade was almost entirely in dollars. In 2023, Bloomberg tells us that about 20% of the entire global oil trade was in non-dollar currencies. That's a big number out of a very low, zero start in just 2 years. There's kind of a story behind this. Now, first of all, just to explain why gold is being used as final settlement, if you are Russian and you're sending a lot of natural gas to China, as they are, you're getting back a lot of yuan if you're not dealing in dollars. Of course, you have some need for Chinese goods and services, but if you have an excess of yuan, the People's Bank of China, through the Shanghai Exchange, is sticking up its hand and saying you can have gold for those yuan. So they're buying back the yuan and using gold as the final settlement. So, that's where the 20% of oil trade in a $1.5 trillion market, by the way, can occur in currency other than dollars. It's the fact that gold is universally acceptable as a form of settlement that makes that possible. Now, there's a further backstory that goes back to 1971, and it's kind of fun. So if you'll indulge me for a minute, I'll tell the story. 1971, of course, everyone knows that the U.S. closed the gold window, went off the gold standard, and that was an action by President Nixon at the time. The Saudis were not very happy about that. They did not want a strictly fiat dollar in settlement for their oil. And the US was a major oil importer, much to its chagrin, as we went into the decade a little deeper and we had the oil embargo. So the US had to deal with this issue. And on the other side was Sheikh Yamani. He was the Saudi oil minister and also the head of OPEC. And it was his view that a depleting resource, namely oil, that the Saudis had to offer should not settle in a depreciating currency, that is a fiat dollar. So the US administration, and Henry Kissinger was a key part of that, decided that a strong dollar policy was a good idea and that they should proceed to drive gold out of the financial system now that it was no longer backing the US dollar. So they set about to do that. And the mantra at the time was to make the dollar as good as gold for oil. And that was primarily to satisfy the Saudis. Now, it took a while to put all this in motion and to make it stick. But the final most potent move in that regard was Paul Volcker, head of the Federal Reserve, and basically introducing extremely high interest rates. Now, of course, everyone understood that that was to moderate inflation, and so it was. But it was also to drive down the gold price because there was quite a bit in the gold price, in part because of the closing of the gold window. So we had real rates went plus 10% at one point. That crushed inflation. It also crushed the gold market. And for 20 years after, or almost 20 years, we had a gold bear market, and we had a stronger dollar. So the strong dollar policy was a success, and it helped to maintain an intimate relationship between gold and the dollar. Now, once we got to the dot-com crash and then the global financial crisis, these issues and the dollar printing that went with them eventually have removed this policy of the gold dollar being as strong as gold for oil. And we're now seeing a very different situation in which gold has been freed. And you can see that as soon as we had the problems of the dot-com crash, gold was released. The dollar was no longer the alternative to gold it had been perceived to be. And, that's where we are now, where we can see that, in fact, gold is independent of the dollar, and probably dollar weakness is no longer as important as it was in driving the gold price, but still a factor. And I think with rate cuts coming up from the Fed and with the unwinding of a very large yen carry trade, we're going to see a weaker dollar as well.
That's a fascinating piece of history, Jim, bringing us right up to today. And we'll talk about your views about the potential for Fed rate cuts in just a moment. I want to get to shift gears here a little bit and talk about one of the big macro factors affecting gold. At least that's the perception of many, and that is the massive debt of the U.S., the massive deficits. It's estimated now that annual interest expense on that debt is more than $1 trillion. That's more than they spend for defense. You've talked about Ferguson's Law and why these facts could be quite ominous for the U.S. What is Ferguson's Law and the significance of the fact that the Fed or the U.S. rather, is spending so much on their debt?
Well, in Ferguson's Law is Neil Ferguson, who Scottish-born historian, very well known, currently at Harvard, I believe. He's much published and much admired as an historian. His basic premise is that when interest expense runs higher than defense spending, empires come quickly to an end. And we have the famous cases of the Roman Empire. There's the Habsburg Spain, the Ancien Regime of Royalist France, the Ottoman Empire, uh, the British Empire. These are his examples, and it's it's a fundamental issue that right now, as you said, interest expense in the U.S. federal interest expense, Treasury interest expense has gone through $1 trillion. It has exceeded defense spending. So if you look at the actual numbers right now, it's 3.1% of GDP on interest, 3% on defense spending. But this is just, unfortunately, probably the beginning. We're seeing very rapid increases in interest expense as debt rolls over from periods when it was issued at much lower rates and has to be renewed at much higher rates, reissued. So you can easily see that we'll be at 1.6 trillion through next year, at some point next year. When you look at the fact that at the end of 2023, interest expense was only 600 billion, you can see that this is a very rapidly increasing expenditure, which is really tearing apart the US budgetary process and stands to get worse. So there's that issue, which is really an issue of how much debt is too much debt. There's also the deficit, which continues to grow. Some really nasty numbers came out just recently on July deficit, $248 billion just for the month. I think the total expenditure was 573 billion, which was up 15% from July of last year, comparable month. And tax revenues were 330 billion. Now, even Jay Powell, chairman of the Federal Reserve, has said that he thinks the debt is sustainable, but the deficit is not. Well, I think that definitely the deficit is not sustainable. It's running about 7% of GDP. Now, is this sustainable? As he suggests, maybe it's not. Well, the market doesn't seem to care. What will make them care? Well, one thing would be a recession. If the US economy does slip into recession, and there's some indications in the last jobs report, for example, that then you could see the deficit running from 7% of GDP to 12% or maybe more. This would be very unnerving to the stock market and the debt market. So when is too much debt really too much? I think we may be close to that. One risk, as I said, is that. Another risk is that the US political system is looking somewhat questionable these days. There's a lot of uncertainty. That could make US debt less desirable. And so that's another factor that has to be considered. So if you look at the gross numbers, the big numbers, that's one other thing, that maybe is not fully appreciated, and probably stock market players will be happy to hear this, but the U.S. Treasury cannot afford to have a lower stock market. The stock market generates probably as much as 15% of total tax revenue. So there are all kinds of vulnerabilities here that can make this debt unsustainable, despite what Jay Powell has said. So we think, Rudy and I at Seabridge, that this is probably the issue that's going to drive the next leg in the gold bull market, is a dissatisfaction with the treasury market, and probably a discontinuous event in the treasury market. Right now, you'd have to say that bonds are the enemy of gold. Why? Well, because they're both risk-off investments, and bonds have a nice interest rate, and if they're treasury bonds, well, of course, you're always going to get your money back. If the market loses some confidence in that fact, and the increase in debt, by the way, the debt is growing at about $1 trillion every 100 days, an increase in the deficit, problems in the political system, uncertainty in the political system, all these things could make bonds a lot less desirable. And that's going to have positive repercussions for gold. So all things to watch. It's a vulnerable system because there's too much debt for the size of the economy, and something could and probably will go wrong.
All right, Jim, let's stick with the Federal Reserve. The market is now pricing in multiple rate cuts, likely starting in September. And you said that you believe those cuts will eventually lead to negative real interest rates again, and the potential for quantitative easing, which we haven't seen formally for a while. We saw it sort of informally during the pandemic. So can you take us through that scenario and how that may play out?
Yeah, one thing is we have an interesting historical precedent. The last time the U.S. had such a high debt to GDP ratio was just after World War II. Not surprising. Wars are expensive. That one was very expensive. How did the Fed deal with that? Because 6 years later, it wasn't an issue. The fact is that they ran negative interest rates of, in real terms, of minus 14%. That's a staggering number. People think about that, they don't believe it. But in fact, that's what the Fed did. They used yield curve control, and they simply bought all the 10-year treasuries that were offered to them in order to maintain a 2.5% yield. So, there's nothing like the precedent of success to enamor a Federal Reserve or government body of any kind. The fact is that inflation is needed, not popular, but needed if you want to bring down debt to GDP and bring down the ratio. And it probably needs to come down to the 60-70% area from its current level of 122% if the U.S. is to get back to some form of fiscal health. Will we see yield curve control in the near future? I mean, I think that there's a very good chance of that, given the fact that it's increasingly difficult to fund the U.S. Debt and deficit. Now, it may not look like that, but there are little signs, if you're willing to look around, that suggest that maybe this is going to be a big issue, perhaps even in the next few months. For one thing, there's the MOVE index. This is an index of volatility in the Treasury market. It had a big day on Monday of this week, went up 9% to 118. Luke Groman, who's I think one of the smartest macro analysts around, tells us, and he points to the facts, that 130 is a very important number, that after that, the volatility starts to cause anxiety at the Fed, and they start to do things they wouldn't otherwise do to add liquidity. There's also the Bloomberg index, which measures the truth, like we could say, of the yield curve. And if you see a lot of anomalies of issues, particularly off the run issues that are trading a little off the curve, then that's an indication of a lack of liquidity. And that index is up a lot in the last few weeks, alarmingly so. And that indicates that there are a lot of these anomalies. Now, there is a solution for those anomalies, but I'm not sure, everyone would want to hear what they are. Hedge funds are having a hell of a good time trading what is called the basis trade, where for pennies they will sell the futures and buy the cash, or vice versa, wherever there's a little gap that they can close and take the profit. The Financial Times pointed out that the leverage on some of these trades is absolutely hideous. Not uncommon to see 100 to 1. Why? Because they're treasuries, so the banks are willing to be generous. If we get a credit event in the treasury market, it has all kinds of possible consequences out of keeping with the apparent size of the event. And so there's, again, fragility in the system. And, if everything goes fine, then everything will be fine. But I think it is quite possible that we will see, once again, a play that leads investors to believe they should have more gold, more safety, more risk off, when even bonds themselves, and especially the treasury market, becomes an area of greater risk than we're used to.
And Jim, just sticking with the Fed and the possibility of cutting interest rates, do you think that Jay Powell and his crew are very aware of history? Thinking of the 1970s, for example, when Arthur Burns was running the Fed and they felt they had inflation under control, but then it was reignited. And so how concerned do you think Jay Powell is about potentially reigniting inflation if he starts cutting rates aggressively?
Well, is inflation the real priority for the Fed? They tell you it is. Every FOMC meeting, we have a press conference afterward, and Jay Powell tells you and tells the American public how important inflation is and how they're working diligently to bring it down. But in fact, there are two things more important to the Fed than its dual mandate of inflation and full employment. They are the treasury market and the banking system. And one of the main reasons we're going to see a reduction in interest rates is because the treasury market is, as I pointed out, a little less than ideally liquid, but also, and probably more importantly, in the short term, the banking system has a $1.3 trillion hole in its balance sheet due to rising interest rates, which have brought down the value of bonds, which they bought because the Fed changed the rules and made them buy those bonds when foreigners stopped buying them. Now, yes, there is a concern that the Jay Powell not become the next Arthur Burns, but realistically, how similar is the situation now to what it was in 1970 when Arthur Burns was appointed Fed chairman. And yeah, he has a negative reputation because inflation got away from him in the 1970s, but it really wasn't his fault. It was a lot of fiscal spending by the central government. But just look at some numbers here. I looked these up the other day because I kept hearing about this Burns argument. If you look back at the difference between now and 1970, the U.S. is no longer the world's dominant manufacturing sector. We have at the time we had a net positive balance of foreign investment. Now it's minus 78% of GDP. That is, foreigners owning more of the U.S. than the U.S. owns of foreign economies and securities. We had a trade deficit back then of essentially zero and a budget deficit of 0.3%. So, Powell is dealing with a really different set of circumstances. I think things are really pretty much out of his control. If only the federal government would stop making things worse by increasing spending. As indicated, 15% higher spending this July than last July. But that doesn't seem possible in the current political situation. Neither party seems to be very intent on cutting expenditure. So, these are the multiple issues the Fed has to deal with. And I think that inflation will end up not being the most important thing. They will, in fact, desert the primacy of inflation as a policy objective as they turn to the state of the what Croman has called fiscal dominance, where the degree of expenditure and the deficit and dealing with those issues becomes more important than the current rate of inflation.
You did a nice job there, Jim, of breaking down the 1970s versus today's environment, and Arthur Burns versus Jay Powell. Let's get the stocks here. The GDX ETF as a proxy for stocks in the gold market. It's up around 40% in the last 6 months or so. Do you think the generalist gold investors are coming to the party just yet, or not really?
Not really. One of the reasons that is just looking at the level of GDX, that is gold stocks, versus gold. If you go back to the last, let's see, let's pick a date. I've got some old figures here. If you look at say 2007, the ratio of GDX to GLD, the physical gold ETF, was 0.54. Today, it's 0.158. It's about 70% lower. This is a really staggering underperformance for gold stocks. And the reason is that gold stocks have not been offering what they need to offer in order to attract investor attention. They have not been good surrogates for purchasing physical gold. The problem is that the metrics, the per share metrics, don't work. So on a per share basis, production of gold has gone way down. It's also dropped in absolute terms, but on a per share basis, it's not untypical to see major companies now trading at 75% less gold per share than they did back in 2007. It is even more the case that reserves have declined despite the rising gold price, because per share metrics on reserves are really pretty abysmal. So GDX it consists of mostly producers who have not been providing gold investors with a sufficiently effective play on gold. So that's something investors really have to watch for, and it's the reason why GDX has not performed as well as gold. It's you could also say it's in part because Western investors have not been involved in the gold market. They've been sellers, and the buyers of gold are Western investors. You don't typically get Eastern investors, and certainly not central banks, who've been the big buyers, buying gold stocks. On the other hand, when you look at how small the gold stock market capitalization in total is, it's probably somewhere around $300 billion US. That's what, 10% of Apple? So when the big guys do get involved, when the generalist investors, as you've suggested, Mark, start to take more of an interest in the gold sector, gold stock sector, I think you won't need a microscope to find the result. I think the movements will be pretty dramatic, but not yet. In part, I think because they want to see the Fed cut rates. I think that's a factor. And perhaps in part because they are no longer or not yet ready for, I'd be a better way of putting it, a risk-off investment. And if they are, they'd rather have bonds, treasury bonds in particular. So they're not there yet. They will come. I guess there's that famous story, if you build it, they will come. I think the gold industry itself has cleaned itself up a lot. The balance sheets are stronger. The management is better. Costs are pretty well controlled, given this is an inflationary environment. The arguments are in place to get the big generalist investors into the gold stocks, but not yet.
All right, and everybody's waiting, of course, for that
That's right.
explosive move whenever it may come. Lastly, here, Jim, we're not looking for stock picks or advice necessarily, but and we know that every case is different for every investor. But in
Sure.
terms of constructing a portfolio of physical gold and gold stocks, do you have any ideas on how an investor may want to approach that, or at least if they are deeply involved already, how they may want to rejig things?
I think the problem with the industry in general is that it's busy trying to turn, or actually turning, gold into cash. Cash flow, of course, is a very good thing, keeps you in business. But the investor is not trying to buy a gold stock for cash. The cash it's generating, it's the gold. It's all about the gold. So the industry is kind of on the wrong side of the curve. They're taking a really good currency, best currency, which is gold, and they're turning it into a not so good currency, fiat dollars. But there are exceptions. So I would say that probably the most important thing for gold investors is to start turning more attention to companies that are successfully turning cash into gold. And that means that despite the fact they are producing, and maybe they aren't, they may also be companies that have accumulated a lot of gold in the ground. But let's stick with producers for a moment. Perhaps they're generating more reserves than they're mining. That would be a really good thing. I think you would find that those stocks are going to perform much better than those that suffer from a declining reserve base, which is not uncommon. So look for the ability to explore well. This doesn't tend to be a thing that the big companies do well. It's more the intermediates and smaller companies that find new deposits, but that's the area that is most likely to generate value. So look for good exploration records. So I would say, in general, look for companies and management that do like the idea of turning cash into gold, of increasing gold reserves. Obviously, I come from the experience of Seabridge Gold, where that was the total focus and remains so. But I'm not here to suggest you buy that. There are other companies out there that deserve the work and the attention to find out who they are and support them in the process of generating that most valuable of all currencies, which is gold.
Jim, do you have any final thoughts for us? Is there anything we haven't touched on?
Well, I was wondering, I've been thinking about this while we've been talking. I was thinking of doing a thought experiment because I put this up the other day on a chat site, and it seemed to get a fair bit of attention. So let's suppose I'm retiring in 1970. I'm going to use US dollars and the US experience, but the same will be true in Canada and elsewhere. So let's suppose I have about $300,000. And you look it up, you can get a risk-free return of about 7%. So you retire on $21,000 a year in 1970. By the way, that was pretty good. That was considered a pretty good pre-tax income. Okay, so now here we are in 2024. What do I need to do to be equivalent? Well, dollars worth of purchases in 1970 is $8.10 today. It's a 720% inflation rate. So I now need pre-tax $170,000 of retirement income. And by the way, taxes are probably higher now too, but I'm leaving the tax issue out. I'm not a tax accountant. Okay, what do I need to generate $170,000 worth of pre-tax income? Well, at 5%, the risk-free rate currently, I think we could agree on that, I need $3.4 million. Yikes. Okay, let's roll it back. Go back to 1970, $300,000. I buy gold. I can buy about 8,500 ounces. Okay, come forward to 2024. What's that worth? $20.5 million. So the advice that would tend to arise from this, for any of us, smart enough to add 2 + 2, is that you should go on your own personal gold standard. You should own some gold or gold stocks that increase their ownership of gold. That's fundamental. Now, as a gold bug, and I am one, I admit it, it's not something you want to go back on a gold standard because that involves government setting prices in the gold price. You don't want that. And it's not in any likelihood possible now, given the fact that all the paste is out of the toothpaste tube. I mean, we're very used to living beyond our means and running up big budget deficits. I don't think that's going to change. But you can go on your own personal gold standard and do yourself a real favor. So that would be my message, and is my message. I go on my friends and family. get on the gold standard and give yourself a chance to retire with dignity.
Well, what can I say, Jim? We got a thought experiment exercise, a real education, history lessons, facts and figures, and deep insights into many different themes and topics surrounding the gold market and gold stocks. We can't thank you enough. That was really great.
Mark, thank you for inviting me. It was fun.
It was fun, and that is definitely worth a rewatch. Thanks a lot, Jim.
Okay.
We'll see you. We'll see you soon. Okay, Jim Anthony, a founder and former chair of Seabridge Gold. How good was that? We hope you appreciated that. And again, definitely worth rewatching to make sure you got everything and take down some notes, which I was doing as well. Thanks for watching once again. Next week, Mark Selby, CEO of Canada Nickel. He'll be here next Thursday for another one of these live core conversations. We'll see you next time.